Before 1863, the United States had no national banking system, no central authority-controlled currency or credit. It seems almost impossible to imagine a modern country, especially one as powerful as the US, thriving without a formal banking system, right? But for nearly a century, this was the reality. Without banks, the economy relied on an intricate web of local systems, each tailored to the needs of its community. Farmers, merchants, craftsmen, and even the government worked together through a practice so different from what we know today that it might as well be from another world. Yet this system wasn't primitive, nor was it inefficient. It was a carefully crafted alternative. In fact, some of the most iconic American landmarks were built under this system, from the US Capitol to the homes of America's founding fathers. The question remains, what was the system that replaced the banks, and why did it disappear? Was it really replaced for the better, or was there something far more profound at play? Back then, there was no Wall Street, no Federal Reserve, no credit cards or interest rates. There were no giant corporate banks controlling the flow of money. The economy was built on something far older, something that had worked for centuries in different parts of the world. It was a system of trade, credit, and mutual obligation, a complex dance that bound people together through face-to-face agreements and community trust. In place of money, a wide range of barter systems, local currencies, and even handwritten notes or promises to pay were common. Even when it came to large-scale projects like building the nation's most significant landmarks, the communities didn't rely on conventional financing. Take the construction of Independence Hall, for example. The craftsmen who worked on it weren't paid in the traditional sense. They didn't receive hourly wages, and they didn't have to borrow money from a bank. They were paid in what they could trade or barter, and they worked together based on a shared understanding of fair pricing. This may sound shocking, but it was a system of fairness that benefited everyone involved. It wasn't based on what the market could bear, nor on what clients could afford. Instead, it was based on something known as unit pricing. Unit pricing meant that each task, whether it was cutting a piece of wood or laying a brick, had a fixed, standardized price. This price wasn't determined by the whims of a market or negotiators. It was set by experienced measurers, a group of skilled workers who ensured that the pricing was fair and not subject to inflation or exploitation. And perhaps most surprising of all, this system of pricing wasn't only used by builders. It was used by the community at large. In the absence of centralized banks, people could extend lines of credit to each other based on trust. A farmer might provide crops to a merchant in exchange for tools or supplies, and the merchant would pay him back later. The credit was extended not on the basis of wealth, but on the understanding that the community would hold its members accountable. These systems allowed communities to flourish without the need for a formal banking infrastructure. As strange as it may seem, this was how early America operated for a long time. But when the National Banking Act of 1863 was signed into law, everything changed. This new system marked the beginning of centralized banking and the gradual dismantling of the old systems. But why? Why did the United States, a country that had functioned for so long without banks, suddenly embrace the very institutions it had lived without? The shift that came with the National Banking Act of 1863 wasn't just about creating a more efficient way to manage money. It was about consolidating control. The law established a national currency, regulated by a new government entity, the Office of the Comptroller of the Currency. For the first time, the country would have a single standardized currency that was accepted across all states, no longer dependent on the myriad of local currencies or barter systems that had been in use. The move was aimed at creating stability in a growing, increasingly interconnected nation, but it came at a cost. By centralizing the banking system, the government also handed over control of money to a small group of financial institutions. These banks, many of them large corporations, now had the power to create money through loans and credit. They were no longer simply a mechanism for facilitating trade, but the very engines driving the economy itself. With this new power came a change in how wealth was distributed and how people worked. No longer were tradesmen paid for their craft in goods, services, or fair prices set by the community. Now they were paid in currency controlled by distant banks, and the value of their work was determined not by skill or fairness, but by the whims of the market. The local economies that had once thrived on mutual trust, barter, and shared responsibility were gradually replaced by a new model, one driven by profit and control. The beauty of the old system was that it allowed people to create value in a more tangible and direct way. When a craftsman built a piece of furniture or a farmer sold his crops, there was no middleman taking a cut, no interest on loans, and no corporate entity profiting from the transaction. The system was designed for the benefit of the community, not the bank or the corporation. But as the banking system took hold, it brought with it a new kind of dependence. Workers now had to rely on the currency issued by banks to buy goods, pay for services, and meet their needs. Money became a scarce commodity, a tool that could be withheld or manipulated by those who controlled it. The introduction of interest rates and the practice of lending money for profit began to shape the way people worked, lived, and interacted with one another. This shift wasn't without resistance. There were many who saw the centralization of banking as a threat to the independence and self-sufficiency that had defined the early American system. The struggle between those who advocated for a free, decentralized economy and those who sought to consolidate power within banks would continue for decades. The tension between these two systems, the old guild-based economy and the new bank-driven model, was a defining feature of the Industrial Revolution. As the new banking system took root, the promise of financial freedom and opportunity that had once been a cornerstone of American ideals began to shift. Instead of a system that allowed individuals to create wealth on their own terms, the central banking system created a world where wealth was controlled by a few powerful institutions. The dream of a fair, just economy where everyone had access to opportunity was replaced by one in which access to wealth was determined by one's relationship to the banking system and to the debt that came with it. But even as the old guild system faded away, elements of it still lingered. The Amish, for example, continue to operate in a way that resembles the old system. They don't rely on banks, and instead, they function on a system of mutual aid and communal responsibility. When someone in the community faces financial hardship, the Amish come together to provide the necessary support. This tradition of mutual obligation, where people help one another without the need for centralized institutions, stands in stark contrast to the modern banking system. As we look back at the rise of the modern banking system and its subsequent effects on American society, it's important to ask, was the shift really necessary? Could there have been another way? Could the old system, where communities operated on trust and mutual support, have continued to work in a modern industrialized economy? The answer isn't simple. There's no question that the new banking system brought certain advantages, namely, a unified currency and the ability to create credit that helped fuel economic growth. But at what cost? The transition from a community-based economy to one governed by financial institutions fundamentally changed the way Americans viewed money, work, and value. Money, once a tool for trade and exchange, became a commodity in itself. It no longer represented the value of goods and services, but rather the value of debt and interest. This shift from tangible goods to intangible debts created a cycle where wealth became less about what you could create and more about what you could borrow. It's a system that encourages consumption over production, where the drive for profit often outweighs the welfare of the workers and the community. One of the most significant consequences of this shift was the erosion of local economies. As banks took control of currency, they began to dictate the flow of money throughout the country. This centralized system favored big corporations and wealthy individuals who had the means to access credit. Smaller businesses and individual workers found themselves at a disadvantage, often having to rely on loans with high interest rates or facing financial ruin when the economy faltered. The system wasn't designed to support the individual, at least not in the way the old system had. The guild system, in contrast, was designed to foster fairness and shared responsibility. It worked because it kept wealth circulating within the community, ensuring that everyone had access to the resources they needed to succeed. In a guild-based economy, a person's value wasn't determined by their credit score or how much debt they could take on. It was determined by their skills, their work ethic, and their contributions to the community. In a way, the guild system was a reflection of a more egalitarian society where everyone had a role to play and a fair chance at success. And yet, that system was dismantled, replaced by one where the value of a person's labor is often dictated by forces outside of their control. Today, the average worker is not paid for their skill, but for the market value of their labor as determined by banks and large corporations. This disconnection between labor and value has led to a situation where wages stagnate, while the cost of living continues to rise. People are left with little choice but to take on debt to keep up, perpetuating a cycle that benefits the few and burdens the many. But there are still remnants of the old system even in today's world. The Amish, as previously mentioned, continue to live without the constraints of the modern banking system. They have created their own way of living and working that is based on principles of mutual aid, shared responsibility, and fairness. Their model isn't about avoiding progress. It's about creating a sustainable community where people rely on each other rather than on external financial institutions. And while the Amish way of life is unique, it serves as a reminder that there are alternative ways to build an economy, ones that don't depend on debt or the control of money by a few powerful entities. In fact, many communities around the world are beginning to look at alternative economic systems inspired by the old guilds, cooperatives, and barter networks. These systems, though small-scale, are proving that it's possible to operate outside the constraints of the traditional banking system. By focusing on local trade, fair pricing, and shared responsibility, these communities are showing that it is possible to create a more equitable system of exchange, one that doesn't rely on profit-driven institutions that put the interests of a few above the needs of the many. The question remains, what can we learn from this history? Is there a way to bring back some of the old systems while embracing the benefits of modern financial systems? Can we create a hybrid economy that values both community and innovation? The answers aren't clear, but the patterns are hard to ignore. The old system of guilds and mutual aid may have been replaced, but its legacy lives on in the way we still think about community, fairness, and the value of labor. In a world where the economic system seems increasingly rigged in favor of the wealthy few, perhaps it's time to reconsider the lessons of the past.